juicy, right? But how about now?
Please.
Come here. Why should you pluck before they ripen? Why should you hit and kick until it's no longer desirable? Why should you harvest without her permission? You stare.
You're in your 400 level, right?
Yes, sir.
You don't want to risk coming back again. You have to just...
Until you demand her fruit in exchange for grades. If you see something, say something.
Hold it right there.
Girls and women are tender gifts. Let's nurture them, even as they nurture. Sexual and gender-based violence is against nature. Let's end all crimes today.
This project is supported by the Wole Soyinka Center for Investigative Journalism under the Report Women FIRP Fellowship.
Our website, channelstv.com, has more information on our top stories and others. Subscribe and watch Channels Television's live stream on YouTube and other social media platforms using your mobile device browser. Or download the Channels TV app for Android and iOS devices from their respective stores. You can also watch us via your smart TV platforms on Apple TV, Android TV, Fire TV, and Roku. Channels Television, ubiquitous.
Good morning, good evening. Wherever in the world you're watching from, it's Business Morning live on Channels Television. I'm Ladi Williams. First off, let's kick off with markets now. Oil prices rose to 2-month high today. Traders waited to see if the European Union would reach an agreement on banning Russian oil ahead of a meeting on a sixth package of sanctions against Moscow for its invasion of Ukraine. Brent crude futures gained 46 cents to $119.89 a barrel, while U.S. West Texas Intermediate crude jumped about 60 cents to $115.67 a barrel, extending solid gains from last week. The EU is due to meet today and Tuesday to discuss a sixth package of sanctions against Russia for its invasion of Ukraine, which Moscow calls a special operation to disarm its neighbor. And incorporating climate issues is the sustainability standards for industries is one concern of the Minister of Industry, Trade and Investment, Otumba Adeni Adebayo. This he highlighted as the Financial Reporting Council of Nigeria draws attention to mainstreaming Nigeria's collaborative action on climate-related risk and disclosures. Do take a listen.
To develop a comprehensive global baseline of sustainability disclosures for capital market operators and participants. The board proposed its first two standards, one, which sets out the general sustainability-related disclosure requirements, and the other, which specifies climate-related disclosure requirements. These standards ensure that companies engaging in capital market activities fully recognize sustainability-related risks and opportunities in order to meet the demand for high-quality, transparent, reliable, and comparable reporting by companies on climate and environmental, social, and governance-related issues from international investors with global investment portfolios. Setting sustainability standards for global industries will further enhance investors' abilities to make more informed financial decisions. It is therefore important for companies to incorporate climate issues into their future economic outlook.
All right, now to our first conversation. Nigeria's manufacturing sector grew by 5.89% year-on-year in real terms in the first quarter of 2022, an increase of 3.61 percentage points from the preceding quarter, which recorded a growth rate of 2.28%. Well, let's discuss this and other issues in the manufacturing sector. Joining us now in the studios, Mr. George Nofowoko, MD, CEO, Coleman Wires, join us right here. Great to have you. Good morning.
Good morning, Ladi.
So, the last time we had a conversation on this set,
there we go.
There was no war in Ukraine, and inflation was not a global issue, at that time, but it was rising. But now it's all everyone talks about. So I'm wondering, how is all of this impacting your sector?
There's no market where inflation is at the level at which we are. If you look at last month's level, which we're now almost heading to 17%, we're talking 16.82% with a movement from April of 15.8 or 9 thereabouts. So you have almost a 1.9%, almost a 1% basis point increase in inflation, almost month in, month out. There's no market that is good. Inflation levels, of course, we will have preferred the single-digit inflation level. But if you look at what is impacting, food is impacting it. We're having also real factors, consumer goods, your petrol, your diesel prices have gone up. And those are impacting real sector. And in that variables, when you look at the last 2-3 months, for instance, just even taking diesel moving from an all-time high of 400 now to an all-time high of 800, then coming back to stability of 700. Those are impacting inflationary figures. It is not good for manufacturing, but unfortunately, we are in the world we're in today with what happened in Ukraine in February. We could see what happened instantaneously on food prices, maize coming out of those areas, grains coming out of those areas, steel, aluminium for people like us, and copper coming out of Russia. Now, those impacted the figures instantaneously. Now, you saw all indexes going up, including commodity prices going up all over the world. And for instance, you had a copper jump from close to about $8,000, they're about $9,000 to an $11,000 high, all between the war period. So, unfortunately, we're dealing with too many crises in the world at the same time, post-COVID. And that everybody is expecting life to go back to normal. Then the war starts and everything impacts our figures. It's impacting us negatively. There's no doubt about that. Inflation basically means our buying power starts reducing. The faster it grows, it's not in our interest. That is what we see with the impact of MPR finally actually going up because it's now moving too fast. And for us, the manufacturers, yes, we're seeing growth. Nobody's doubting that. Everybody in the world saw growth post-COVID. You don't close down a world for 2 years, then you wake it up. You wake it up instantaneously, growth will. Inflationary GDP figures for most countries were at the highs of 6, 7, 8, 9, 10%. It was
normal for them to pick up.
Yeah, it was normal for them to pick up. So the key thing is now we're having a knock-on effect of a pickup now almost being stagnated by inflation, impacted by what is happening in the world with Ukraine, what post-COVID was supposed to bring. And for Nigeria, for a country like Nigeria, and not only Nigeria, Africa, we're a country dependent on importation and a continent dependent on importation. So the impact of those importation and the impact that that happens to them in the world does directly impact us. And those are what sees those indexes change negatively in the case of manufacturers, positively in some other people's cases where you're doing financial instruments. Now, but where do we go from here? That is the question now. That's the question.
So, now, with recently we've seen all central bankers, globally, most of them are raising rates at this point. We had the expansionary, policy from the central bank right here in Nigeria, but the last meeting, we saw a rate hike, and we've got mixed reactions, coming from that. But really, how is that impacting or how do you see it impacting your industry?
Negative.
Now you have to borrow at a more, expensive rate.
No, the sad part is, and this is Nigeria for you, sad part is MPR goes up. The day it goes up, literally look at the letters you get from your banks within 24 hours to a maximum of 48 hours. You will get that letter. It's almost a week. They don't sleep. As if we wake up, we see MPR go up, we send our letters to our customers telling them MPR has gone up 2%. So therefore, all our rates are going up 2% or more. Now, if MPR goes down, they all go to sleep. That's the reality. Now, so we're getting we're getting instantaneous impact of that. It was inevitable. Inflation cannot be rising up at about 17% and NPR rate staying at about 11%, 11.5. It wouldn't be, the gap is too much. Now, one thing that is also good is that because we've seen inflation at this level, we have to commend the developing banks and both central bank and both Bank of Industry that have literally tried to soften the blow to the manufacturing sector. So where you're actually having the intervention rate going on. And the intervention rate, to be fair on them, is still a post-COVID rate at 5%. And that doesn't end till end of February next year. So you have the 100 for 100, you have the DCR, you have the Bank of Industry, Central Bank, industrial funds. All those things are still going on. Most of the manufacturers are all beneficiaries of it. They cannot say they're not. So there's cushioning blows. So we cannot knock what is happening without saying we're trying to create cushioning blows. Now, it's those cushioning blows that are seeing those effective rise in manufacturing indexes. So, because when you're having enough cushioning blows, you are able to actually still secure the right amount of financing. So, financing, even for a manufacturer, is a case of average. What is my average cost? My average portfolio of funds. Now, if I go to my commercial bank, which is killing me with higher interest rate, I don't want to mention the figures because
the real figures.
They're going to call me the next minute and say, Mr. Nofoko, are you enjoying that same figure or the rest? Now, so I don't. But the real figures are definitely in the double digits, in the higher double digits of the. Close to, you'll say, between 16 to as high as 25, 28, depending on the manufacturer. For trading businesses, it can go as high as 30%. So those are the realities. Now, the key question is, how much of those intervention funds do you have with a blend of the higher interest rate to blend your average rate? Now, as long as our average rate continues to be sustainable, most manufacturers will continue to purchase. So the inventory figures will go up, which is why you're getting the PMI figures, the Purchasing and Manufacturing Index, actually going up 51% to 54% as we see it now. But the key question is, what also, there's a flip side to manufacturers buying more. Yes, the market is moving, the market is getting better, but the question also is that they could also be projecting inflation risk at the moment. So you're seeing prices rise. So what do? You buy more and stock it against the price shifting to your customers. So you're finding out that most manufacturers are now buying literally forward of their projection of the risk that they associate to prices going up. So I see maize going up and I need to use maize for my manufacturing. Instead of me buying 100 tons, I buy 500 tons. Now, I stabilize the prices because I bought enough to take me maybe the next 3 months. But then the cost of finance is now playing a part.
That impacts your cost of
business. It does. There's no way. The inventory cost is going up. So if you look at that, yes, manufacturers are buying more. The market is moving more. But we're indirectly turning ourselves to bankers. Yes, that's what to say. If you look at the amount of stock you're carrying, our inventory level, safety level, for instance, for ourselves, can be as high as 6 months. In some cases, as high as 9 months. So if you're taking inventory stock of 9 months, you take the financial cost of a 9-month stock rolling into in every manufacturer's warehouse. We're a bank. So billions and trillions of money is tied up in inventory unnecessarily because we're all speculating two major things: inflation, gap, movement risk. We're also looking at the FX risk. So FX today, FX tomorrow moves 5, 10, 20%, and it's galloping.
FX is another huge elephant.
It is.
In the room right
you
now.
Find out that the index is looking up because the manufacturers invariably in Nigeria, out of what they've seen post-COVID and pre-COVID, pre-COVID and post-COVID, they started literally turning themselves to banks. Now, so when you look at most figures of most of the companies today, their stock levels is higher than they used to carry 3-4 years ago.
So can consumers, be rest assured that, prices won't go up that much?
I think it wouldn't. In my own view, if you look at the Nigerian trend, inflation moves up, food prices move up, but look at the manufacturing indexes. They don't move up at the same pace. Because what has happened over the years, especially in the last 5 years, is that manufacturers themselves have become strategists. So they've moved away from just literally manufacturing to literally having financial strategy, inventory strategy on all their businesses, budgetary planning for what you're going to buy. It's literally a whole working experience on its own now. Because if you don't, and your product is not elastic enough for you to keep passing on these prices to your customers, it will get to a point you shut down. Now, which one pays you better? Take some extra financing costs, manage price levels throughout the year. So where, Nigeria, we're lucky that the manufacturing sector has so been battered over the years that they've turned themselves to an holistic business. They're their own government because they own all their infrastructure, their power, their sources. They're their own financial department. They have their own treasury department, and they're literally occupying almost every area of business.
How sustainable is this, really?
For an economy like Nigeria, it doesn't look like it's sustainable, but it's become the norm, the new normal. And really, if you go to any business in Nigeria today, and literally they don't have almost all that department sitting in, you won't find them being very successful. Now, so you find that their bank, they understand treasury and treasury management and money management as well as their bankers. They understand the policy and instruments of policies, both fiscal and monetary policy, as well as any person in CBN or Ministry of Finance. But really, that's not our core business. But we have turned ourselves into, you look at me, I'm sitting here now, I'm a core manufacturer in Nigeria for over 25 years. And I'm talking economics.
Right.
But we're a very big manufacturer. We'll be successful because we have blatantly looked not only in the manufacturing sector, we've looked at what balances manufacturing. And financial instrument understanding is a key factor to getting this manufacturing going. And manufacturing is doing better because we've changed our mindset and decided to be what everybody doesn't think we should be, but now understanding and accepting that it's now the norm, that if most people advising or advisory companies sit with you and they see you don't have this vast understanding, or the company doesn't have this risk elements that they are actually mitigating, the tendency of you getting into trouble is easy. So right. You don't mitigate the risk for FX, for instance. FX,
talking about FX now, we've seen that, cross the 600, naira mark in the markets we don't like to talk about.
You know what?
Handling that?
Oh, God. I think, I said this to some of the, because I'm part of mine and I sit in some of the committees. And one of the things I said to them last time, I said, we're fighting a wrong fight. The reality is that we're all sitting here, most of the manufacturers, big and small, have already priced in these figures we don't like talking about, parallel market. The question is, when is the government going to be bold enough and just narrow this thing into one single digit? Because we're literally penalizing the economy and the masses and the consumers. Now, I'll say that because you're talking of that parallel market figure. There's some products that you just cannot get the elasticity of this product. There's no matter what price you call it, everybody's going to buy it, right. Especially food-rated ones. Now, what can you do in that scenario? So what is happening with most of those manufacturers? They're buying their raw materials at whatever the going rate is, whatever they can get the inflow rate is. Now, how do we change that dynamics? I need to be able to source funds, whether from the central bank is saying, yeah, we're going to move away from central bank influencing that figure. Let the commercial banks influence it. But they must be able to source it. So let's have a single window. In my own impression, a single window naira today is definitely not the figure we're saying. Far less than that figure. Now, how less it's left to you allowing the exporters to move their prices as they like? Because if I'm an exporter of cocoa today, or processed starch or glucose, whatever material I'm exporting, I need to be able to trade it at whatever prevailing market is. So the windows have to change to one single window, allowing free market movement. It will impact us, but it's already impacted us. If I'm telling you that we're all not thinking about what, because I want to buy machinery. Okay, today we opening up a fiber optic cable factory, and we're also opening up a gap cable for transmission. But now, if you look at those two things, fiber optic is not available, but everybody is using fiber for data. Now, key question, how do they buy it? They're buying it on FX. I spoke to some of the big players in telco, and they're telling me it is terrible for them to get some of this material.
Right. So much to so much to unpack there, Mr. Anofogo. Well, we'll keep watching, and hopefully we can have this single window, at some point. It would be interesting, to see that happen in Nigeria. Thank you so much, Mr. George.
Thank you, Laddie.
Always great having you.
Always
right
great
here.
to be here with
NBCO
you.
Coleman Wires. Thank you so much. All right, we'll take a break now. When we come back, we move on to our next conversation. That's a moment. Just stay with us. All right, now to our next conversation. Well, last year, 2 years after the executive order number 007 was signed by President Muhammadu Buhari, the scheme for 21 critical roads received a boost when the Nigerian National Petroleum Company Limited handed over 621 billion naira check to the Federal Ministry of Works and Housing. The scheme seeks to encourage public-private partnership intervention in the construction and refurbishment of road projects in Nigeria. Well, let's discuss developments in the infrastructure tax credit. We have Idris Ejimarua, a tax policy analyst, join us right there from Abuja. Great to have you on the program.
Good morning, Laddie.
Good morning. So, we're aware that the federal government, has pushed to construct new infrastructure, nationwide, and seeks to involve the private sector, in major ways. But what can you tell us about how the Presidential Executive Order 7 works?
First of all, it's very important to know that from reports available, there is an infrastructure deficit in Nigeria of almost about projected to be about 120 trillion in the next 26 years. Now, going by the present budgetary allocation, in which the capital budget is less than 30% of the total annual budget, is going to be a very tough order to meet up the infrastructure demand. So in trying to meet up the infrastructure demand, the government under the President Muhammadu Buhari signing the Executive Order 007 on 25th of January 2021. Now, this executive order to encourage public-private partnership in the development of road infrastructure, because the Executive Order 007 is titled Road Infrastructure Development and Refurbishment Investment Tax Credit Order 2021. Now, we see a lot of companies with large tax credit liabilities and who are also suffering from lack of infrastructure. Just like your last speaker said, Mr. George, the infrastructure gap in every angle from roads to telecoms to power. And now to meet up this infrastructure on roads, this executive order is to involve private sector. The beautiful thing about it is this: the private sectors are supposed to do their proposal, focus on infrastructure that mainly controls that are of importance to the operation, and instead of paying FRS their tax credit liability arising from corporate income tax, they simply use the fund, naira to naira, to do these infrastructural projects. And this will encourage fast infrastructure development. Everybody's a winner. The government is a winner. The people are winner. The economy is boosted. The interconnectivity between states, the movement of goods and services will be well funded. And with this, in a short while, because the order has a time lapse of 10 years, and we hope that in the next 10 years, we would have largely closed the infrastructural gap to a point that our annual budget will be able to take care of the Nigerian needs. So this is what has been happening. And looking at NNPC following the PIB, that's the PIA, the Petroleum Industry Act, the NNPC being now a liability, unlimited liability company, now decided, because today, as it is, as reported by FRS, NNPC is the highest tax-paying company in Nigeria today. And looking at that huge tax liability, I've decided to take over and carry out an intervention on 21 federal roads, cutting across the 6 geopolitical regions, the North Central, the South-South, the Southwest, the Southeast, Northeast, and Northwest. And this is a very fantastic project because it has timeline to this project. The timeline of 24 months. So you are not sure that despite that this project is financed by NNPC through the Federal Ministry of Works, the NNPC will be able to manage and ensure that within this short timeline, these infrastructures are provided.
Hello, Mr. Rua.
Yes, sir.
Okay,
yes, sir?
Yes. So I wanted to ask, what is the difference, between this tax credit scheme and, corporate social responsibility? What's the, fine line between these two concepts?
Now, corporate social responsibility are not tax-based. These are free will activities of the companies, basically to the community where they exist, and to ensure that, okay, they contribute to the environment where they operate. But when you talk of these tax liabilities, credit liabilities, it's a one-to-one. For instance, you first have to present your document for FRS. FRS has to determine what your tax credit liability is. Then you now write a proposal for the project. So instead of paying this money in cash to NNPC, what you simply do is to carry out this project under the supervision of the relevant ministry to the exact value of your tax liability. So it is not a tax exemption scheme or a social responsibility. Social responsibility is something you decide to do out of your profit, probably out of your, after-tax profit.
Looking at most of the companies, involved, these are, mostly, big companies. Is there a barrier to entry into this, tax credit scheme?
No, going by the act, the executive order, there's no barrier because you are supposed to sit down, write a proposal. There's a committee called the Road Infrastructure Development and Refurbishment Investment Credit Tax Scheme Committee, headed by the Minister of Finance. You write your proposal to them, they'll study it. On this committee, you have BPP, you have FRS, you have other relevant ministries that have to do with infrastructure. They'll now look at your proposal and say that, yes, the cost you attach to it, the timeline you attach to it, is realistic, then FIRS will look at your tax liability and give the necessary approval. They will issue a certificate to go ahead and execute the project. So there's no limit. You job, but the executive order 007 is specifically on roads. On roads, not other infrastructure. So if you're going to present a proposal, based on this executive order, it has to be on roads.
Quite interesting. But why is the NNPC getting involved, and what exactly are they doing within this initiative?
Now, if you look at NNPC, over the years, we've had issues of disruption of their services. One, the pipeline, the former PPMC, was supposed to distribute product through the pipeline all over the country. But this network has suffered due to continued vandalization. And because of that vandalization, the pipeline are virtually down. So NNPC had to rely on road transport for energy distribution. So there's a big problem with energy security, energy distribution all over the country. And most time, NNPC's attempt to meet up the demand across the country is being faced with threats from petroleum tanker drivers, National Association of Road Transport Owners, who threaten to go on strike because of bad roads. So you cannot see NNPC involvement. NNPC is investing in massive sum of 621 billion, covering about 1,800 kilometers of roads all over the country, from North Central, where they are investing about 244 billion to construct a 791 kilometer road, South-South, 117 billion to construct 81.9 kilometer road, Southwest, 81 billion to construct about 252 kilometer road, Northeast, about 56 billion to construct 273 kilometer road, Southeast, 43 billion to construct about 122 kilometer road, and Northwest, 23 billion to construct about 283 kilometer road. And if you take analysis of all these roads, let's start from North Central. You look at the troublesome, because this has been a headache to the Federal Ministry of Works. In fact, I think for a very long time since I was a child, this road has been a troublesome one. The Ilorin, Jeba, Mokwa, Bokani road had been a very terrible road. Now NNPC is putting so much resources, then putting up other resources within the North Central, up to Lambata, Bida, Mokwa, Makera, Tagina, Minasulija, and this is likely because of the depot, the strategic depots of NNPC that exist within Niger states. Now, when you also look at the south-south, you look at the Idopani to Ikotek-Pene road, which they are dualizing, and the Iko-Iboku power plant, which they are also dualizing. This is also a massive road that will push a lot of the resources upstream from the Niger Delta. We have the same similar project all over the other region. And these roads, if they are done, the issue of energy distribution, energy balancing, and petroleum will be there. And this threat of petrol tanker drivers and National Association of Road Transport Owners will be off. And NNPC will also be good for it, because it means more business, more money, more profit, more taxes for the country, and employment, and boosting the economy.
All right. Thank you so much, Mr. Idris Arua. Well, it's a 10-year scheme. We'll keep tracking to see the progress of it all. Thank you so much for coming on the program as tax policy analyst. It was great talking to you.
Thank you very much.
All right, now, so let's head on to the market. We have Willie Bonk standing by right there. Well, Will, quite an interesting week for the equities market last week.
It was interesting. But what's more interesting is that the comeback, you know, we saw the rate hike from the CBN, the Central Bank's Monetary Policy Committee, and then boom. It came back like it didn't happen. So we'll probably get insights on that probably tomorrow when an analyst speaks more about that. Now, looking forward, we're going to start with the FX market, where Nigeria's forex reserves decreased by $125.53 million week on week to $38.60 billion as of the 24th of May. And that's, you know, I don't know, despite the, you know, the boost or the hike in oil prices. However, trading activity at the forex market was slightly mixed. We saw total turnover of transactions at the FX sports, forwards and futures at $870.53 million, up 29.1%. And this was largely driven by the 126% gain we saw in the FX derivative market, despite the 5.54 decline in the FX sports segment. Now, for the FX futures market, we saw a total of $334.59 million there. It was up about 569%. Now, there were about 35 deals in the FX futures market, but we're seeing, you know, an uptick in that region, but we'll get more insight about that possibly later. Now, meanwhile, the Naira depreciated at the NAFEX window, 0.23% down to 418 Naira, 77 kobo to $1, as against 417 Naira for 6 kobo to $1, which we saw in the previous week. Moving forward to the fixed income market, we saw bearish sentiment, you know, dominating the fixed income space. Investor sell-offs in reaction to the MPC rate hike on Wednesday. You know, what are the gains that were recorded at the beginning of the week? And average yield across instruments expanded by 8 basis points, closed at 11.2%. Now, we'll move to the Treasury bills market. We saw similar sentiments there, closed on a bearish note on the back of depressed system liquidity and the adjustment in the secondary market rates. Now, we have Odinaka Linus Wokonko to tell us more about that. He's a fixed income dealer at Access Bank. Good morning, Odinaka.
Hi, good morning, Willie. Thanks for having me.
Well, it's good to have you.
Yeah,
we're seeing bearish sentiments. I know you're listening in and you heard what I said about bearish sentiments permeating the fixed income space last week. Are we already seeing now that's the impact of the CBN's MPC monetary policy rates, the rate hike that we saw? Now, what's the level of impact here? What are we talking about? How significant is it?
Okay, so last week the MPC raised the monetary policy rate by 150 basis points to about to 13%. So what we saw was an instant bearish market. In fact, immediately after that meeting, we saw market about 70 to 80 basis points up only on the bid. We barely saw offers in the market on the fixed income space, particularly on the bond market. However, as market progressed, we saw that spread continue to tighten. Market settled around circa 30 to 40 basis points up with the 2042 instruments trading at 13.3 levels on the bid, and offer was around 13.2 levels. We saw the on-the-run 10-year instrument, which is the 2032, settling around the 12.6% level, while the 2025, which is the shortest on-the-run paper, trading around the 10.30%. And this also filtered the next day when the DMO had an NTB auction.
I think we lost Odinaka there. Will, you can carry on, Will.
So basically, Odinaka is talking about what we saw in the Treasury bills market yesterday, especially in terms of rates. He talked about rates rising about 30 to 40 basis points after the rate hike this week's close this week. That's phenomenal for the fixed income space. Now, we move quickly to the fixed income market, where we closed positive. The market closed positive, up 2.09% last week, you know, clinching a new record highs, you know, historic highs. Airtel Africa contributed mostly to that phenomenal gain that we saw, pushing the market, you know, to record highs, 54 basis points there, 54,000 basis points. Equity cap is at 29, the first ever we've seen in the equities market. Now we move to the volume, the activity chart was not, you know, reflective of the market, but it showed, you know, a lot of deals. Possibly we don't know what happened there, but deals and volume and value were a bit low for last week compared to the previous week. Now we move to the sectoral performance was also a sea of red. We saw banking, consumer goods, industrial, insurance, and oil and gas all in the red, and we wonder how we had that positive close. But, you know, it is quite surprising. The market is quite very versatile, and it doesn't depend on what the investors are doing at the moment or what the sectors are doing, but what the volume that is being pushed to the market and the value that is being raised there. So we also go to the NASD market where we saw a 0.02% uptick. That's also, you know, trailing the equities market, positive close for the week last week, and we're hoping that the market kicks off today positive, because I want to report good news, you know, Ladi, and then volume also up, value up, deals, you know, at 743 deals we had, 43 deals. Yeah.
Let's hope the profit takers don't, you know, wake up and, you know,
the profit takers are not, probably they're sleeping, they still haven't taken a nap at this moment, then they're just going to wake up still and just say maybe, okay, what's happening? Right. But I'm not sure they're going to take so much profit. Probably mild profit, but not significant profit.
Well, we'll keep watching that space. Thank you so much. We'll take a break now. When we come back, we head to London. That's in a moment. Just stay with us. Welcome back. Now we head to London. We have Juliana standing by right there. Great to have you, Juliana. Good morning. Well, a recent report shows 6 million homes could face winter power cuts due to energy shortages. What are you hearing about this?
Good morning, Laddie. Yeah, the headline sounds pretty bleak and grim, but this is a worst-case scenario. Draft which has been put together by Whitehall. The British government do this often. They are always looking ahead. Well, we hope that they are. And of course, the situation in Ukraine doesn't show any signs of abating. So they are drafting a worst case scenario outlook. And it does include the fact that 6 million households by the end of the year, if Russia decided to completely turn off gas and energy supplies to the EU, they would be put into a blackout. That is because even though we don't get our gas from Russia, well, not much anyway, I think it's about 0.5%, we do have interconnectedness because a lot of these pipelines are all connected to one system. So if they did decide to completely switch that off, then our supplies would be dwindled, and then there would have to be peaks on the weekday, on the weekend, between 9 and 10 in the morning, and between 7 and 8 at night, where the electricity would have to be turned off. It is pretty bleak, but the government have said, you know, there is no cause for alarm. We're doing this because we want to be a responsible government, and we want to make sure that we have all our I's dotted and T's crossed, just in case this situation does happen. I think now it's going to be a really difficult couple of months for the Business Secretary, Kwasi Kwarteng. We know that Britain has been right in the front and centre about getting to net zero by 2050. And one of the reasons how they are going to be doing that is stopping the use of coal plants. Many of them were supposed to be phased out by September, so we can have a complete transition by 2024. But that is not going to be the scenario now. It's deemed that coal is going to be an essential part of getting out of this electricity supply issue. So they are going to be speaking to those who are looking after these coal facilities and asking them to keep their powers on, which I think is going to be a spell of good news for people who thought they'd be losing their jobs.
Right. We could comfortably call 2022 the year of gas, the way it's going. But a consumer goods giant, which owns a controlling stake in David Beckham's portfolio of branded products, is racing to finalize a £300 million takeover of Ted Baker. How do you see this deal?
Yeah, that's right. Authentic Brands Group, a pretty popular US-based retailer, venture capitalist type of firm. They do look after a lot of sports brands, as you said, David Beckham. I believe Shaquille O'Neal is another brand that they look after. They appear to be the front runner for a £300 million takeover of Ted Baker. Ted Baker, a very popular store here in the UK, but as we know, with a lot of high street retailers, they've had a pretty tumultuous time during the pandemic. As with so many others, they let go of thousands of staff. They closed hundreds of stores, but they did appear to stage a recovery. They staged a recovery since restrictions have been lifted. Ted Baker is kind of seen as a staple UK high street retailer. So many were sad when they did announce that they may not be able to survive. In fact, I think during the past 18 months, their share price has sank about 90%, which is a huge amount of money. But the ABD believe they have a plan for them. They're not yet the exclusive front runner, but I do believe that they are shoring up all their finances, and they've come in with £300 million. And I think bosses at Ted Baker think that's a good bid.
Right. Well, 90% drop. That's pretty big. Oh, thank you so much, Juliana. We'll get you back to you at 1:30 on Business Incorporated. Thank you so much.
Thank you.
All right, now let's take a look at other markets this morning. Well, we're seeing quite a recovery there happening in most markets. We know that inverse relationship between the oil markets and risky assets. Well, looking at Bitcoin this morning, we saw quite a recovery. It started a fresh move above the $28,500 support. Look at the Fear Greed Index there. It's moved back to 10% this morning. It was about 13% last week, but now we're seeing it at 10%, even though the market is having some form of recovery. But I guess there's a lag with that sentiment. Well, the price of Bitcoin this morning, there we have it, $30,655 with a market cap up 6.05%. Volume traded $61.99 billion. And we see volume traded in Bitcoin this morning, $24.79 billion. We have Ethereum there trading at $1,906, still below that $2,000 support mark. That's turned to resistance at this point. It's about 7.12% this morning. So we're seeing quite a green market right now, even though the market is deeper into extreme fear. Let's bring in Christian Essien now, DeFi analyst, join us on the program for the first time. Good morning. Great to have you.
Hello, good morning.
Good morning. So, you know, there's been this talk about a bear market, and we've seen that happen in global equities market too. And the last time the crypto market had a bear market, say around 2018, that lasted for about 3 years, if I'm not mistaken. But now we are in a bear market. What else are DeFi specialists doing in that space at this time?
Well, I'd love to say we do a lot of things. Well, you can think of our space as a how would I explain this? It's the crypto space, yes, but there are a lot of other opportunities. One, you have developers. Two, you have people who get jobs. Three, you have people who trade shit coins, people who trade meme coins. Basically, decentralized finance has basically put a source of market, has opened another source of market, whereby if people lose money in the crypto market, in the normal market, even the decentralized finance market, because I believe some DeFi coins are down, there are other sources of avenue where you can make your money. Right now, I see because of the Fear and Greed Index, I see that so many people are trading shitcoins. They don't know what they're doing, right? So when they don't know what they're doing, they tend to lose a lot of money, right? But it's not like I just want to try my luck. Where in the I just want to try my luck market. So that's where we are right now.
And you know, talking about DeFi, I know most of these, you know, protocols and platforms have, you know, some kind of staking, you know, going away, you stake tokens and, you know, you get more and you're able to, you know, make a profit with that. But with the prices going down, how is the staking market looking?
Well, I wouldn't advise buying a token with a staking protocol in a bear market, unless you have the token has very strong fundamentals, like increase in total value lock. Let's say when you see an increase in the total value lock, you can check that with DeFi Llama. When you see an increase in TVL, you can notice that they are building. Now, when I talk about building, it means they're getting development funds. Investors are trusting the project more. That increases the level of liquidity in that protocol. So when I see a protocol that has a very strong and increasing TVL, I know that, oh, okay, this is increasing. Then I know that staking to increase, because TVL is like a bank for a new trend. When TVL increases, the trend increases. A trend tends to set in. It happened with Cosmos, it happens with Metis, it happened with AVAX, and it happened with Phantom. Phantom in the downside, AVAX in the upside, Cosmos in the upside, Metis on the upside. So basically, when you talk about staking, we're talking about how you staking is directly correlative with increase in price action. So when I know that these fundamentals are really strong, I know that there's going to be an increase, then I can be comfortable to lock my money and stake.
Right. So before staking, you need to check other parameters like the total value locked and all of that. So you just don't go around staking and staking something that doesn't make you money at some point. All right, Christiane Essien, thank you so much. DeFi analyst, it was great having you on the program.
Thank you.
All right, now let's look at the top alts by market cap. We see it's mostly green on that counter, with Cardano, the biggest movers, up about 12.40% this morning, trading at 51 cents. Incredible. Cardano was trading about $3 at the high. But now we're seeing most of these altcoins battered at this point, but we're seeing quite a green market this morning. And top 5 gainers there, we see GMT topping that counter up about 33.85%. So it's looking good in the crypto market. It'll be interesting to see how the market closes today. All right, that's it for the crypto market, and that's it for the show today. Thank you so much for watching. Remember to join us at 1:30 for Business Incorporated for more business updates and developments, and we'll have our very own Willie Bong taking on that at 1:30. Thank you so much for watching. I'm Ladi Williams. Bye for now.